God morgon, måndag den 21 november. Välkomna till Paretodesken. S&P stängde upp 0,5% i fredags efter en ganska volatil vecka som på totalen slutade upp 0,2%. Vi hade bra data i början av veckan som visade att inflationen är på väg att rulla över, men sen så kom lite utspel från Fed-representanter som satte käppar i hjulet. Men trots det så lyckades vi få en helt okej utveckling för veckan då. Det här kom ju på en väldigt stark performance, S&P upp 10% sedan mitten av oktober. Och vår makrostrategi samarbetspartner Longview Economics har nyligen sänkt sina utsikter för aktiemarknaden till underweight, och det ska vi tala lite med dem om. Just to do that we have Chris Watling from Longview Economics. Good morning, Chris.
Morning, Stefan. Morning. Lovely to see you.
Yeah, good to see you. Can you please tell us a little bit about the reasoning about your recent downgrade to underweight equities?
Yeah, I mean, I think what we've seen another classic bear market rally. So we had markets rallying quite nicely from, late September time through, I think, to last week. We probably started to see the high. We had quite a good move, about 15% or so on the S&P 500 global equities from lows to highs. And what we saw is our models move quite dramatically from people being really pretty fearful. You remember back end of September, we had the pension fund debacle in the UK, and we had markets selling off quite hard into that event. And then really over the early October, they found their feet and then took off and rallied quite hard. We had that big move up that one day on CPI, pricing an awful lot. And with that, all our models have moved a lot. And, they're back on sell, and quite punchy sell signals telling us market participants have become greedy. And, with that, we think the primary trend in this market is down. So we don't want to hang around once we start seeing some of those model signals. So, the bear market is still ongoing. There's still more downside to price in. And with those models moving back to sell, we downgraded to underweight on the short-term tactical models and short-term tactical weighting. So, yeah, so that's where we are at the moment.
Yeah. How should we think about then going into 2023, and what type of sectors would you suggest to go long and perhaps not go long?
Yeah, I think this is a great question, because even though the market should be trending down into the start of next year, and maybe Q1 and perhaps Q2 as well, there are still opportunities emerging, and many parts of the market become very cheap. And if you look at a sort of distribution of the single stocks PE ratios, you'll find there's a ton of cheap stuff in there. So some countries are cheap. Some of the UK market's quite cheap. Europe's pretty cheap in part. Emerging markets are becoming cheap. And within this global stock market, you find some real opportunities. And what we're looking for is stocks that have been beaten up a lot by higher bond yields, and therefore are going to do well as bond yields start to fall off and bonds start to rally, which we think they will do. I mean, we think the bond market's priced in enough interest rate hikes. It's priced in enough hawkishness, and now it's going to start thinking about the coming recession and inflation easing from here. So yeah, a lot of opportunities. You could look at things like home builders, retailers, some of the financials in the West. They're starting to look cheap, and we have this other theme that markets have fashions. And sector leadership changes in every bear market. And so we're evolving from growth and IT, which was the sector leadership, to other parts of the market, which we think will be leadership going forwards from here. So lots to look at and think about.
Yeah. A final question then, when speaking a little bit about bonds and equities, we've seen a quite unusual sort of positive correlation during the year, and you expect that to reverse and go back to the more normal negative correlation. Can you give us a little bit your thoughts on that also, please?
Yeah, that's absolutely true. I mean, we've had a positive correlation, both equities and bonds going down in 2022, highly unusual, as you say, for the last 20 years anyway. And we think that'll reverse, because it looks to us like bonds are going to start rallying and equities are going to continue to sell off. As I said, I think there's more to drive this bear market on the downside, and bonds have started to top out on terms of yield. So So I think as we move to price in the recession, we'll go back to a more negative correlation on those two asset classes over the course of 2023, which is actually pretty normal in the sense of the history of the last 20 years or so of the global stock market. So yeah, I think that dynamic's changing. That's important because there's a lot of chat out there that as bond yields rally, you should go back into growth stocks, and I'm not convinced that's the right approach. As I said, I think the sector leadership in the market is changing, so growth has had its day.
Okay. Thank you very much, Chris. Highly interesting. Have a good day.
Thanks, Stefan. All the best, and you.